Hey, everyone, welcome to Stable Dividends. Today, what we're talking about is the magnificent seven dividend stocks that can double your money. We're also going to talk about the Rule of 72. Hey, if you guys are new here, thanks for coming. Make sure to hit that subscribe button. If you guys are subscribers, welcome back. Appreciate you guys as always. Again, today what we're gonna go over is the seven best dividend stocks that are going to double your money. And we're also going to talk about the Rule of 72. So let's briefly go into that. So the Rule of 72 is pretty simple. It's a simple formula that calculates how long it'll take for an investment to double in value based on its rate of return, right? So let's do an example here, and you can do this for share price, right? Or you can do this for dividend growth, right? For example, let's say you have a high yield portfolio that only grows at about 4% per year. So we're going to take 72, we're going to divide by the dividend growth rate of 4%. So it'll take you about 18 years to double your money on average, right? That doesn't include dividend reinvestment, of course, just a simple tool. The next one, let's just take 72 divided by like an average stock growth rate, right, of like, let's say 8% per year, pretty good. So 72 divided by 8 is going to equal 9 years of basically doubling your money. You'll double your money in 9 years. The final one is what we're going over today, these high growth stocks. So you take 72 and we'll divide by something like, let's say 16% growth every single year. And that's going to be 4.5 years, right? So in the first scenario, it was 18 years, then it went down to 9 years, and then now it's down to 4.5 years, right? So we're halving it every single time. So just to give you an idea, that's what the Rule of 72 is. You can use that, again, for share price per year, right? That kind of growth, or you can do it for dividend income. And this video is all about how do you double your income. All right, so before we get into it, I just wanted to say thank you to the subscribers. We have some new ones here, Hector, Rubio, and R. Colic. Really appreciate you guys jumping on. Let's get started with the video. So the first one is going to be Costco. The reason why this project actually started in the first place is because I was like, I just love Costco so much. Let me look into their stock, and I frankly want to invest in it. And why do I want to invest in it? One of the biggest reasons why is because they actually, you can buy other dividend stock products there. Like I buy stuff from Starbucks there all the time. There's Coca-Cola products there. There's Procter and Gamble. There's Apple, right? There's so many different products there at Costco. And basically their strategy is, hey, let's buy in bulk for very cheap. Then we're going to sell it to our customers. And they basically like cap their profit margin. It's actually pretty wild. So basically you're selling to a bunch of people with a really good price. And there's always a line. I remember I went there one time at 10 in the morning and there was a line. And it wasn't like they were releasing anything. There's just always a line at Costco. So it's absolutely amazing. It's just an amazing business. Let's go through some of the stats. They're a consumer staple, basically company, right? And so they have a dividend streak of 19 years of consistently increasing their dividend every single time. They have a yield of 2.25. Now, normally this is actually 0.55. The reason why it's a little bit different is they actually pay out special dividends. So as you can see here, right, they're just paying, they're paying. And then all of a sudden you see this giant spike, right? They go from $1.02 and they pay $15, right? So Costco is known for this. Special dividends are a thing. They're not super common, but they pay it every once in a while. So they paid it in 2023. They paid it towards the end of 2020. And then they had one in 2017, and then they had one at the beginning of 2015. So that's why their dividend yield is a bit higher than usual. They have a payout ratio of 26%. They have a 5-year dividend growth rate of 12.33%, a 10-year dividend growth rate of 13%, a 5-year total return, including dividends, of 259%, and finally, a 10-year share price return of 739%. For reference, guys, if we look up here, this is what VTI did at a 5-year total return, including dividends, and this is a 10-year share price return. So obviously, you're killing the market there. And then also Costco, their buybacks are up. They're constantly buying back their stock. Their earnings are constantly up, right? Earnings, or share price, excuse me, follows earnings. And lastly, experts predict about a 12% upside with this stock. So something to keep in mind. The next one is going to be Microsoft. Microsoft is a technology company. I think it's the second biggest company in the world behind Nvidia and ahead of some other companies. But their dividend streak is 19 years, right? So every single year for 19 years in a row, they're constantly increasing their dividend. They have a smaller yield at 0.68. They have a great payout ratio of 25%. You always want that payout ratio low. They have a 5-year dividend growth rate of 10.2, right? That double-digit growth rate. They have a 10-year dividend growth rate of 10.6. They have a 5-year total return, including dividends, of 251%, and a 10-year share price return of 965%, absolutely blowing the market out of the water. And of course, with Microsoft, the buybacks are up, the earnings are up, and experts say about a 20% upside for this stock. So that's absolutely fantastic. They do stuff like Azure cloud storage, they have Xbox, they just bought Activision, and of course they have Microsoft Word. Before I continue here, I just wanted to say, if you are new, please hit that subscribe button. We've actually made a lot of progress here. We're already at 10% of people subscribing. So really, really appreciate that. It helps out the channel a ton. Now back to the stocks. The next one is going to be Visa. Visa, they have a dividend, right? They're in the financial space. They have a dividend streak of 15 years in a row of constantly increasing that dividend. They have a dividend yield a little bit higher than Microsoft at 0.77%. They have one of the lowest payout ratios out here at 21%, which basically has that dividend, has a ton of room to grow, right? And then we have a 5-year dividend growth rate of 15.93% and a 10-year dividend growth rate of 18%. They have a 5-year total return, including dividends, of 65%, which is under VTI, which could be signaling a buy, but a 10-year share price return of 416%. Now, what I want to do is show you guys, right? This video is all about doubling your money. Let's take some of these dividend growth rates, right? So we'll always take the bigger one because obviously it's more fun, but 72, let's go by Costco's, right? Costco, 13%. We're going to divide that by 13%. And that's going to be a 5.5 years, and you'll double your money. Absolutely wild. 72 divided by, let's go Microsoft, right? Divided by 10.6, and you'll get about almost 7 years, and you'll completely double your money. That's actually one of the slower ones on this list. The next one, Visa, 18.05%, right? So you do 72, again, divided by 18%. You're going to double your income in 4 years. And this is not talking about share price or anything else. This is just income alone. It's very, very powerful. This also does not include dividend reinvestment, right? If you're constantly investing your dividends and, of course, buying more, this is actually going to be a lot lower. So it's very, very powerful. Speaking to Visa's, right, their stock, right, at the end of the day, they are buying back. Buybacks are up. Earnings are also up. Again, share price does follow earnings, and they actually have a 9% upside. The next one is going to be Apple. They are obviously a technology company. I think everyone knows them by now. At the end of the day, all their products are great. They have a customer base that's kind of like a cult at this point. You obviously see them, which is, I think, is ridiculous, but they bully people with green text like this. I think that's funny. And lastly, Warren Buffett, right, has this in his portfolio. I think it's like 40% of its portfolio, and they just have a boatload of cash. Speaking of boatload of cash, they are worth $3.26 trillion, just behind Microsoft in third place. They recently eclipsed their 10 years of a dividend streak, so they recently were put into VIG, which I love. They have a starting yield of 0.47. They have a payout ratio. This is the lowest here, which is amazing, at 15%. Again, you want these payout ratios low. Their 5-year dividend growth rate is not too great, 5.56%, and their 10-year dividend growth rate is 8.12%, right? But the 5-year total return, including dividends, is 366%, and the 10-year share price return alone is 851%. So very, very powerful. Again, these dividend growth rates are low, but part of the reason why is because Apple does massive amounts of buyback. They're buying back their stock like crazy. And it's keeping that payout ratio quite low, right? So if you keep that payout ratio low, you can invest that back into research, back into new products, right? Could be anything, acquisitions, right? Like Microsoft buying Activision, or Costco maybe looking into car washes, right? So keeping that payout ratio low allows you to have a lot more cash and freedom to do what you'd like. The next one on our list is going to be Broadcom. Broadcom right here. Oh, and I forgot to tell you guys, Apple has a 30% upside on the stock, so definitely something you want to get into. Broadcom, they're technology stocks, so they do chips, right? And so they have a 13 dividend streak, right? So 13 years of constantly increasing their dividend every single year. The yield, and wait till you see the dividend growth rate. The yield is 1.21%. The payout ratio is getting close to my limit here at 50%. It's at 46% right now. But the 5-year dividend growth rate is 17.5%. And the 10 years, even more insane than that, it's going to be 35% for a 10-year dividend growth rate. The 5-year total return is going to be 700%. That's including dividends. And the 10-year share price return alone that doesn't include dividends is 2,459%. I saw somewhere on Reddit that they bought it early on. They had a yield on cost of 9% for Broadcom. I believe it with that kind of growth rate, that 10-year dividend growth rate, it's absolutely insane. So if we take the higher one, for example, 72 divided by 35, right, 0.28, and we're basically going to get 2 years, and you're going to double your money. Imagine you're making $20,000 in stocks, right? And then basically in 2 years, you're making $40,000 in stocks. It's just absolutely insane. Broadcom here, of course, their buybacks are up. You're starting to see a pattern here. Earnings are also up, and they have a 13% upside. The next one you probably didn't think would be on this list, but it's Lowe's. Lowe's is obviously a home improvement store. Everyone knows about them. I haven't been to a Lowe's in years, but one of the things that's absolutely insane is that their dividend streak, right, is 60 years. 60 years. And the stats going forward are even more impressive. The fact that they have 60 years of a dividend streak going through the Great Recession, COVID, right, the dot-com bust, so many different recessions and economic hardships, and they've made it through. They have a starting yield of 2.06. Their payout ratio is only 35%, which is absolutely insane for 60 years of constantly increasing it. So obviously their earnings are going up. They have a 5-year dividend growth rate of 18%. They have a 10-year dividend growth rate of almost 20%, 19.84. Their 5-year total return is 148%, and their 10-year share price return is going to be 377%. On this stock here, if we're looking at it, it has a 14% upside from experts. Buybacks are up and earnings are up as well. Again, let's look at that rule of 72. 72 divided by the highest one, because we're obviously going for fun. Let's just round it up to 20. So basically in 3.6 years, you're going to double your income with Lowe's, and they have the track record, which is absolutely insane. That's just crazy. The last one is going to be United Health. They obviously do healthcare. People are obviously going to continue to get sick, so it's definitely something that's not going away anytime soon. They have a dividend streak of 14 years in a row of increasing their dividend every single year. Their starting yield is 1.51%. They have a payout ratio, which is great. The 29% in the 20s is fantastic. Their 5-year dividend growth rate is going to be 15.87%, and their 10-year dividend growth rate is going to be almost 21%. Absolutely insane. Their 5-year total return, which includes dividends, is 115%, and their 10-year share price return alone is 500%. So here's the last stock of basically the magnificent 7 here of dividend stocks. We're going to take 72 divided by 21, and basically in 3.5 years, you're going to double your income. So these are the stocks that are going to double your income the fastest. Again, maybe a typical growth rate for VIG is maybe 8 to 10%, right? So when you're getting into the 15%, you're really going to compound and get that income doubling faster and faster and faster. Now, I do want to mention a couple of different things here. So there were some stocks that didn't exactly make the cut just because, I just didn't believe in them full-heartedly, or they didn't have one of the criteria I was looking for. One of them is MasterCard. So if we look at MasterCard here, they actually, obviously they're in the financials industry, right? They're a competitor to Visa, but they do have a double-digit dividend streak. They have a yield of 0.59. Their payout ratio is fantastic in the teens, 19%. They have a 5-year dividend growth rate of 16%, a 10-year dividend growth rate of practically 22%. 5-year total return, including dividends, of 76%, and a 10-year share price return of 500%. I just like having the market leader of Visa. It is actually quite tempting, though, so I might actually have to look into this more. So that's one you can look into. Another one is Home Depot, right? Home Depot has a double-digit dividend streak of 14 years. Their starting yield is great, 2.6. They have double-digit dividend growth rates of 12 and 17 and a half. 5-year total return, including dividends, of 91%, and a 10-year share price return of 336%. My biggest thing was the payout ratio of 58%. Eclipsing 50 is not good. And also, they did decrease, they didn't increase their dividend during the basically 08 financial crisis. So that's something that I don't like. I like to see it very, very steady. Another one is AbbVie. This one is a high yielder, right? So if we look at that, they're also in healthcare. They have a 10-year dividend growth rate. Some would say 50 because they spun off Abbott, but either way, they'd be good on that part. They have a high dividend yield starting at 3.68. Their payout ratio is a little high for me at 55, and they have 6% growth rate for their dividend, but their 5-year total return, including dividends, is 170, killing the market there, and their 10-year share price return is going to be 198%. So those are some good ones. Some other ones, Target. Here's another great one. 55 years of constantly increasing their dividend every single year. That's impressive. 3.21%, 49%, just a hair under 50, which is great. They have a double digit practically for their dividend growth rate. Their 5-year total return is 84%, including dividends, and their 10-year share price return is 147. Under the market, but that 55, that's something that cannot be understated. When you have that long of a dividend streak, you can start to think about, okay, maybe the dividend growth rate doesn't need to be as big because they really, really protect that dividend. The last one really to look at is Eli Lilly Company. They're also in healthcare. They didn't have that double-digit dividend streak yet. They're close. Their starting yield is 0.59. Their payout ratio was a bit high, but look at this in a minute here, 64%, definitely higher than 50. Their 5-year dividend growth rate is 15. Their 10-year is almost 10%, but look at this, a 5-year total return is 756%, including dividends, and their 10-year share price return is going to be 1,309%. So I think if this was lower and this was higher, this would be in the portfolio for sure. At the end of the day, it's not. So let me know down in the comments. You can go ahead and take a screenshot of all these stocks that I looked at. There was a couple other ones, right? Like Oracle, for example, doesn't have that dividend streak, but they do have a low payout ratio. They do have double-digit dividend growth rate, and they're beating the market there. So that's all fantastic. Another one, for example, is actually Goldman Sachs. Is actually pretty interesting. Double-digit dividend streak. They have a good starting yield, 2.5. Payout ratio under 50. Their 5-year dividend growth rate is 27%. Absolutely crazy. They have a 17% 10-year dividend growth rate. And then the 5-year total return, including dividends, is 165%. And then weirdly equal is their 10-year share price return at 165 as well. So yeah, go ahead and take a screenshot. I'm sure there's more. Let me know down in the comments what you guys are adding to your portfolio. And until next time, we appreciate it. Talk to you later. Bye-bye.